With Pankaj Pandey, Head Research at ICICIdirect.com. Pankaj, it's great to have you in the show. Thanks very much for taking out the time. Let's start off with your broad view on the indices and the direction that we would take from here. We've largely been packed in a range, but adjusting higher for the benchmark. And it seems like the selling that we saw in mid-caps and small caps through up till the month of May have abated. I'm just saying, a big May. I'm not sure about that. But what's your sense?
Yeah, hi, good morning. I think if you look at from a market perspective, short term, we would expect markets to remain in a range, probably 10,500 to 11,000 kind of a range. But what we have seen in the last quarter is that we had one of the best quarter results. I think what has been happening up till now is that we were getting a double-digit kind of a top-line growth. But that was not really percolating into a bottom line growth. But what we have seen in this particular quarter is that the large caps delivered about 12% kind of a bottom line and top line growth against our expectation of about 9.5%. And the broader markets did in fact even better at about 12% top line growth and bottom line growth being higher at about 16 odd percent. So which is why we continue to like the broader markets. Our sense is that sectors or segments which deliver higher growth are still finding favor, and which is why the broader markets will keep doing better, except for what we have seen in terms of ASM, which caused volatility recently. Besides that, I think there is no damage to the overall structural earnings. I think the commentary across most of the major players has been very positive, even on the rural side. So I think one should remain constructive on the markets, and any weakness in the broader markets should be used as an opportunity to buy. And I think we still get a lot of stocks wherein the volume growth or the overall growth has been pretty good, and we continue to like these stocks depending on their bottom up performances rather than sort of looking at it from a top down perspective.
Pankaj, morning. I just wanted to understand how critical is this ThyssenKrupp JV for Tata Steel, because now Elliott, which owns about 3% of the company, has said they negotiate a better deal for Tata Steel joint venture, deliver more favorable terms from the JV. They're saying that divergence in performance can be witnessed for both Tata Steel as well as ThyssenKrupp, and the weakness in Tata Steel's Europe's business and the recent financial performance, that they say is a big concern for them.
I think, Aisha, if you look at this JV was extremely important for Tata Steel. If you look at, they're currently sitting on a debt of about 88,000 odd crores. In fact, of their overall valuation, a good chunk of that is debt. Now, if we also look at domestically, they are looking to expand their capacities, plus they'll be which will add some debt, and plus they are also looking to acquire Bhushan Steel, and I think all this will add to the debt overall. And if the company is not able to do, or this joint venture does not succeed, I think it will put pressure on the stock, and I think this JV is quite crucial. So hopefully if this works out, I think it is good for Tata Steel. Otherwise we would expect that the stock will come under pressure because of this news.
Remaining with the same topic, Tata Steel and the JV with ThyssenKrupp, we have seen that how ThyssenKrupp in last 6 months or probably in last 1 year in Europe has managed to improve its profitability and earnings. Now in same region, Tata Steel is underperforming, and that's the main concern what investors of ThyssenKrupp have, that a company which is underperforming is getting forming a JV with a stronger company, and this was the fine prints of the deals were done 6 months earlier. Now my question is not related to deal, but does this highlight that Tata Steel is not a very efficient player even in a European region where other players are doing well in this okay kind of market, but Tata Steel is under pressure?
I think
Pankaj,
if you look at there has been an improvement.
Yeah, please go ahead.
Yeah, so if you look at, there has been an improvement in performance of Tata Steel Europe as well, besides the domestic operations. Domestic operations have been doing far more better, in fact better than what we anticipated. But I think if you are sort of looking at only from a 6 months or a 1 year perspective improvement in performance, I think that is slightly myopic. I think what Tata Steel structurally has been doing is that they've been sort of offloading plants where the profitability has been low or the ROCs has been low. So I think it is absolutely right from some investors to sort of question the deal from a shorter term performance perspective. But I think structurally this deal makes a good amount of sense. And my sense is that with some tinkering it might go through, but what this deal or what this news sort of puts is that there's an element of doubt now in terms of whether what kind of renegotiation if that happens in the deal. Otherwise, I think Tata Steel has been structurally looking very positive, given the fact that now they've realized that the domestic operations are looking far more better. And I think domestically also, if you look at, this is the highest growth regions globally. So which is why I think one has to sort of take cognizance of that. I think Europe operations will continue to sort of fluctuate, and I think one quarter or 1 year of performance may not be a right reflection of the overall trajectory.
Okay, that's the story with Tata Steel. What we're